The IRS just confirmed a brand new tax break specifically for seniors, $6,000 per person off your taxable income, $12,000 if you're married and both of you qualify. It sounds like straightforward good news, and for millions of retirees, it genuinely is. But there's a catch buried in the fine print that's already disqualifying people who assume they automatically get it, sometimes without them even realizing it happened. Every year, new tax rules get announced, and most retirees either ignore them completely or assume they'll just figure it out when tax season arrives. This one is different. It's worth thousands of dollars. It's only available for a limited number of years, and one specific filing mistake can cause you to lose the entire benefit, even if your income clearly qualifies for it on paper. In this video, I'm going to explain exactly what this new senior deduction is, who actually qualifies, the income limits where it starts disappearing, the specific catch that trips people up, and a real strategy some retirees are using to stay eligible. By the end, you'll know exactly where you stand. Quick disclaimer first, I'm not a CPA, a tax attorney, or a financial advisor. This video is educational only based on public IRS guidance. Always confirm your specific numbers with a licensed tax professional before filing. My name is James. This channel breaks down exactly how IRS rules, Social Security, and Medicare affect your retirement income every single week. If that's useful, subscribe now. Next week, I'm covering how this exact deduction interacts with required minimum distributions. Quick question. Are you 65 or older or filing jointly with a spouse who is? Drop a yes or no in the comments right now. Let me introduce you to Margaret. Margaret is 68, single, living in Florida. Her income for the year is $45,000, mostly from Social Security and a small pension from her old job. She heard about this new deduction from a neighbor at church, but had no idea how it actually worked, whether she even qualified, or how much it might actually save her when she filed this year. Here's the first thing to understand. This deduction is officially called the Enhanced Deduction for Seniors. It's part of a broader tax law passed in 2025, sometimes referred to as the Working Families Tax Cuts. Anyone 65 or older by the end of the tax year can claim an additional $6,000 off their taxable income. A married couple can claim $12,000 total if both spouses are 65 or older. If only one spouse qualifies, the couple only gets the single $6,000 amount, not the full $12,000. And here's the part a lot of people miss. This is completely separate from, and stacks directly on top of, the existing extra standard deduction that seniors already received under older rules, meaning it's added, not swapped in to replace something else. Here's the second thing to understand. This deduction works no matter how you file. Whether you take the standard deduction or you itemize your taxes, you can still claim the $6,000 amount on top of whichever method you choose. For Margaret, that means her total standard deduction this year adds up significantly higher than a typical filer under 65, directly lowering the amount of income she actually gets taxed on without her needing to change how she files at all. Here's the third thing, and this is where the catch really starts to show up. This deduction is not permanent. It only applies to tax years 2025 through 2028, 4 tax years total. After that, unless Congress specifically acts again to extend it, it simply disappears from the tax code entirely. If you're 65 now, you have a limited window where this extra $6,000 is actually available to you, and treating it as a permanent fixture of your retirement tax planning would be a mistake. Here's the fourth thing, and this is the income catch specifically. This deduction phases out as your income rises. For single filers, it starts phasing out once your modified adjusted gross income crosses $75,000, and it disappears completely by $175,000. For married couples filing jointly, the phase-out starts at $150,000 and disappears completely at $250,000. It doesn't just vanish all at once either. It shrinks gradually at roughly a 6% reduction for every dollar over the threshold. Let me show you what that actually looks like with real numbers. Say a single filer has a modified adjusted gross income of $85,000, sitting right in the middle of that phase-out range. Their $6,000 deduction wouldn't disappear entirely. It would shrink down to roughly $3,000 instead, cross all the way up to $175,000, and the deduction is completely gone, down to zero. The same shrinking pattern applies to married couples too, just shifted to the higher joint thresholds, phasing out gradually rather than dropping off a cliff at one exact number. Here's the fifth thing, and this is the actual filing catch that's disqualifying people right now, even when their income clearly qualifies. To claim this deduction, you must include the Social Security number of the qualifying individual directly on your tax return. And if you're married, you must file jointly to claim it. Filing separately, even if you'd otherwise benefit from doing so for other reasons, disqualifies you from this specific deduction entirely, with no exceptions written into the rule. Some married couples who normally file separately for unrelated reasons, like protecting one spouse from the other's tax liabilities, are losing this entire benefit without even realizing it until they see their final numbers. Here's rule number 6, and this one catches working retirees off guard specifically. Required minimum distributions count directly toward your modified adjusted gross income. If you're close to that $75,000 or $150,000 threshold, and you take a larger required distribution than necessary that year, you can accidentally push yourself into the phase-out range, shrinking or eliminating this deduction in the exact year you assumed you'd qualify for the full amount. Now let's look at a very different situation. Richard and Susan are both 72, married, filing jointly, living in Arizona. Their combined income is $180,000 a year, mostly because of large required minimum distributions from their traditional IRAs. On paper, they're both clearly 65 or older, so it seems obvious they'd get the full $12,000 deduction. But their income sits $30,000 above the $150,000 phase-out threshold for joint filers, which means their deduction is significantly reduced, not eliminated completely, but nowhere near the full amount they assumed they'd receive. Let's put Margaret's picture together first. Her income of $45,000 sits well below the $75,000 phase-out threshold. She qualifies for the full $6,000 deduction, on top of her existing extra standard deduction. Combined, her total standard deduction this year comes out to roughly $24,150. Subtracted from her $45,000 income, her taxable income drops to just under $21,000, keeping her tax bill significantly lower than it would have been without this new provision. To be fair, this deduction isn't life-changing for every senior. Richard and Susan's situation shows exactly why. Their income above the $150,000 threshold shrinks their deduction well below the full $12,000. And if their required distributions climb even higher in future years, it could disappear for them entirely. If your retirement income already sits well above the upper phase-out limits, this specific provision won't help you much at all, and you'll need to rely on other tax strategies instead. It was designed specifically to help middle-income retirees, not high earners with large IRA balances. Here's a strategy some retirees are using to protect their eligibility, especially those sitting right near the income threshold, like Richard and Susan. If you're over 70 and a half and charitably inclined, you can send your required minimum distribution directly to a qualified charity instead of taking it as personal income. That's called a qualified charitable distribution. That money never counts toward your modified adjusted gross income at all, which can keep you under the phase-out threshold and preserve this deduction, while also satisfying your distribution requirement for the year. For a couple like Richard and Susan, directing even part of their distributions this way could meaningfully shrink their income and pull them closer to the full deduction amount. So here's exactly what to do. First, calculate your modified adjusted gross income for this year and compare it directly against the $75,000 or $150,000 thresholds, so you know exactly where you stand before filing. Second, if you're married and currently file separately for other reasons, run the numbers both ways this year, because losing this deduction might outweigh whatever benefit you were getting from filing separately. Third, if you're close to the phase-out range and taking required distributions, talk to a tax professional about timing or charitable distribution strategies before the year ends, not after your return is already prepared. Fourth, double-check that your tax software or preparer has your correct birth date entered, because the deduction is usually applied automatically, but only if your age is recorded correctly on the return. If this cleared something up for you, share it with a parent or spouse approaching 65, because most people find out about catches like this after they've already filed, not before. Drop your filing status in the comments. Single or married, I read every single one. If this helped you, hit like and subscribe, because I break down changes exactly like this every week. I'll see you in the next one.